Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zacks Market Edge.
Welcome to Zacks Market Edge, the podcast about investing in your life. I'm your host, Tracy, and this week I'm joined by Zacks stock strategist Ben Rains, who's also the editor of the Marijuana Innovator portfolio here at Zacks, to talk about the Zacks rank and the VGM style scores and all things Zacksiness this week. We're also here to celebrate 50,000 subscribers on our YouTube channel. So thank you to all who are subscribing for all of our video and content on YouTube. And we're doing over 10,000 downloads every week for this very podcast on all of the podcasting channels like Apple, Spotify, Amazon Music, and SoundCloud. So thank you for everyone who tunes in to the podcast, just the audio portion, week after week, and who has been doing it for almost, I think it's 8 or 9 years now. It's a long time. So thank you, everyone, for joining us. And again, I asked Ben to be on this week because I wanted to cover the best of the best. These are the stocks that are Zacks #1 ranked strong buys, but also have a style score VGM, as we call it at Zacks, which is value, growth, and momentum, a combined style score of A, which is the highest scores. So these are our highest Zacks ranks with our highest style scores. I thought they would be kind of rare, especially right now, given everything going on in the economy. I didn't know how many companies are we seeing the rising earnings estimates, their values, they have growth and momentum. That's pretty rare. So I ran the screen. We do have this screen on the predefined screens on Zacks.com. If you're a premium member, you can get it. I haven't run this screen in a long time, so I was kind of curious what's in it. And I was surprised. I don't know if you were too, Ben, but 19 stocks. That's what we got when we ran it on this week of August the 5th.
Yeah, well, thanks for having me, Tracy. And I also just want to shout out that I also run the Alternative Energy Innovators portfolio here at Zacks as well. So just,
how could I forget that one?
No, yeah. So just putting that out there. Yeah. So thanks for having me. Yeah. And when you sent me the stocks on the screen this morning, some of them I had not really on my radar at all. So that's another good reason to do these kind of screens here at Zacks, where stocks you may not think of at all kind of pop up, and you're like, wow, you look into them and you say, man, what is this company doing that it's going to do this kind of growth? So it's especially at a time like this when everyone's nervous about the economy and now the market possibly having a big pullback. So it's a great screen to look at, especially today and at the moment we're in right now.
Yeah, I agree. I started looking at these stocks. So Ben and I decided to split it up kind of, and he's going to cover 2 stocks. I'm going to cover 3, but that's just 5 out of the 19 that were on the screen. But I was kind of going down the list to see what was going on with some of the names. And most of them were not necessarily stocks you knew. There were some recognizable names, but it wasn't like NVIDIA was on this screen or anything. And so I was kind of having to dive in. And like you said, Ben, I was surprised at what I discovered on the 3 that I'm going to cover. I was like, dang, they're like crushing it, basically, these companies.
Yeah, exactly. So, yeah, and even the 2 companies I'm doing are probably a little bit more well-known. They might be even household names, but in one of the stocks have done really well, but it's kind of pulled back, but it shows that the business is still doing really well underneath the surface. So that's another reason why these screens are helpful, is it maybe shows that this is a good time to get into some of these stocks as they're pulling back off these highs along with the rest of the market, that the bottom line, the foundation of the stock is still really strong.
Right, for sure. Okay, so what was in this screen that gave us 19 stocks? It was obviously the Zacks #1 rank strong buy, which should hopefully mean the earnings estimates are on the rise. That's how you get the strong buys. We're in earnings season right now in August of 2024. So a lot of changes are being made by the analysts to the earnings estimates. So that rank is changing a lot as these earnings reports come in. But that usually also indicates, again, because we are in earnings season, that somebody maybe is beating and raising or something along those lines in order for the analysts to be raising on these companies that are making this screen. Then we have the VGM score, as I mentioned, is A. But I was surprised by this, Ben. I don't know if you were when you were kind of looking around at the stocks. I kind of assumed if you have a VGM of A that you might get A's across the board. Obviously, if you do, you're going to get an A VGM score. So that would be an A for value, an A for growth, and an A for momentum. But I was surprised on some of the ones I looked at, it might have only had like one A in there and then some B's. Nobody was having anything lower than that to get the A score, though. But I don't know if you noticed anything like that.
Yeah, I noticed that as well. And I think that's kind of just a quirk with the ranking system in general, that they can't give everyone in that system an A. So even if underneath it says maybe you got a C for something or even a little worse, if you actually look into the data, it might not look as bad, and maybe they could be doing better than the median company in that industry. It's just that compared to other things, it's not as good to qualify as a quote A in that VGM system.
Right. No, that definitely may be what it is, but something good is also going on there with the style score side of things to get an A VGM to begin with. So yeah, this screen is literally called the best of the best. But it also has a few other features people should know. It was looking for sales growth as well. It just couldn't be negative. Like it could be any kind of sales growth, but it couldn't be negative, which is good. We do want companies that are growing sales as well. And then it did look for stocks over $5 because we really don't want like the dollar stocks and things like that right now. And it looks for trading volumes over 100,000. So again, that kind of goes to, is anyone really paying attention to this company? And we don't want something that's like a micro cap.
Yeah, especially now the volatility would be really brutal on some of those.
So, right, for sure. Okay, so again, we got 19 stocks when we ran the screen. That was more than I thought. And we're going to lead off with Ben's choices. He picked 2 out of the 19, and then we're going to do mine. So Ben, what do we have?
All right, so we have H&R Block, a tax company that is getting into some more consumer-focused things as well. And then Abercrombie & Fitch, which it was a huge story in 2023. It outpaced NVIDIA, and the stocks pulled back a bit, but you can see when we look under the hood that it still looks really impressive and really strong. So I'm going to go ahead and share my screen, and then we can take a look at, we'll start with H&R Block because it's worth just taking a look at H&R Block. As I said, it provides tax preparation services, other financial products, now small business solutions, and then a mobile banking app is gaining some traction as well. So they're trying to get beyond just that tax-based business into bookkeeping, payroll, advisory, and payment processings for small businesses as well. So just expanding that basic platform that they have with that tax solution. So we can see right now they have that Zacks rank 1, and then they have A for value and A for growth in those style scores. And as I said, this is a little bit of a quirk because the momentum, as we'll see, is actually pretty strong, but it has an F grade there. So just worth highlighting as you're sharing my screen there. So we can see the value is really strong. We can see that it's trading at 11.5 times forward earnings, a huge discount to its industry. That's kind of one I want to highlight there. And then we can go to growth. And then I'm going to show some other things here for H&R Block as well. And then we can see for projected growth on the earnings per share, we're calling for about 11% growth. And that's crushing the average in the industry, which is at a 0.2%. And this is coming after it did roughly 23% growth over the last 3 to 5 years with its historical earnings per share growth. So that's really impressive as well. And then if we look at the momentum, we can see that recently it's pulled back, but over the last 52 weeks, over the last year, it's up 60%. The volume is there as well. So we can see that it's really outpacing its industry. So it's nothing too shocking there if you were looking just at that F grade. So we can see this is over the last year. This is H&R Block stock. It's up about, as I said, 60%, blowing away its broader industry, which is a great sign. And then we can look at some valuation metrics as well. And we can go here and look at this time. This is times forward 12-month earnings here for H&R Block as the chart slowly load. So we can see it's trading at a really solid discount to its broader industry. And if we expand this, we can go over the last 5 years and take a look at H&R Block, and you can see that it's continued to trade at a solid discount to its broader industry. And it's currently trading not too far above its median over the last 5 years, which is at around 9 times forward earnings. And it's solidly below its high over the last 5 years, which is sitting at about 14 times. So it's worth just taking a look at H&R Block stock. And then, as I said, we can go back over here and look at what to expect more broadly, just in terms of what's coming up next. So on the bottom line, we're calling for over 12% adjusted earnings growth this year, and then another 11% adjusted earnings growth next year. So solid top and bottom line growth. And as I said, that top line growth, roughly 3%, and then around 3% again next year. So that's a great sign overall. And we can see that the earnings estimates have improved since its last release. And it's beat by about 10% over the last 4 quarters. So another great sign there. So I think that's really all we need to look at here for H&R Block. But it just shows that if you look at these style scores and you look at the Zacks rank, and you can see really the case for H&R Block as both a near-term and longer-term investment. And now we're going to go over to Abercrombie and Fitch, which is a Zacks rank number 1 buy. As Tracy's alluded to, all these are number 1 buys, the best of the best. And then we have B for value, B for growth, and then a C for momentum. But as I said, with H&R Block, these are not
good either.
These are not necessarily all the reasons why it's getting that A. When you look under the hood, it shows you why it's getting that A VGM score. That sometimes these there can be a little bit deceiving. What you need to look at is just the overall score is what's being aggregated there. So you can see that the strength is there. So if you go to momentum alone, obviously the last 4 weeks have been brutal, but it's been brutal for the home market. If you look at 52 weeks, it's up 241% compared to its industry's 21% decline. It's still up over the last 12 weeks. So it's just this recent downward trend, which is along with the entire market is the reason why maybe you're getting that C. But overall, if you look holistically, it's still really strong. So if we look ahead to the projected growth on the bottom line, we're calling for about 50% adjusted earnings growth. And this is after about 25% growth over the last few years, blowing away its industry's average of about 12.5%. And then we'll go to the value part here, and we can see that it's trading roughly in line with its industry at about 14.4 times forward earnings. But that's coming despite the fact that it's crushed its industry and the market over the last few years. And it's worth noting that Abercrombie has kind of changed its whole business over the last several years. You won't see much branding anymore. It's kind of gone to be more staples and staying on trend. If you go on their website right now, anybody who's listening to this or afterwards, just go on Abercrombie and Fitch. You can see they're selling next to like women's denim dresses. They're selling New York Knicks vintage tees. They have a partnership with the NFL for this upcoming NFL season to have these kind of like trendy throwback NFL shirts. They're also selling sort of I guess you could call like a Lululemon activewear competitor. So they've gone away from that hyper, for lack of a better word, hyper sexualized Abercrombie and Fitch that a lot of people know, to a more adult focused, like mid-20s focused business that's absolutely crushing it. So if we go ahead and take a look at their earnings outlook, we're calling, as I said, 50% growth this year. And this is after last year, they took their adjusted earnings from 12 cents to $6.28 per share. And they did their highest operating margin in the last 15 years. And they already came in above what were their like 2025 estimates to get to that operating margin. And last year they did 16% sales growth. This year they're going to expect to do another 11% sales growth and then another 5% sales growth next year, along with some more earnings growth. And this is after just insane growth last year in 2023, and then really impressive growth expected this year again in 2024. And we can see that its estimates are continuing to trend higher, and its most accurate estimates, which are the most recent ones we have, are coming in well above consensus. So we have it 6% above consensus for the current year, and then 11% above consensus for next year, which is just really impressive. And then we can see it's beat by about 210% on average, including a 29% beat last quarter. So really impressive stuff. And then we can quickly go look at Abercrombie and Fitch here. just to show the stock a little more broadly. So we can see this is that massive run. So it's up about 700% over the last 5 years, destroying its broader industry. And it has pulled back a little bit, as I said, with the market. So this could be, if you're someone who said, oh no, I missed this Abercrombie and Fitch run, you could possibly get in at a little bit better of a buying opportunity here. So we can see that it's trying to find some support here at its 200-day moving average. And as we alluded to as well, its valuation is still pretty solid, even though it's crushed its broader industry. And as I said, it crushed NVIDIA at certain points over the last few years. So it's another stock certainly worth on your radar at the moment, as its earnings estimates are continuing to trend in the wrong direction, even as people are really worried about the economy slowing down. Abercrombie and Fitch is doing pretty impressive business.
Yeah. Do you shop there?
I do not. I went in there with my wife like a year ago, and it was kind of like we were at a mall in the suburbs, and I said to myself, I haven't been in Abercrombie and Fitch. I don't know if ever. My parents, we never shopped there as a kid, and it was not at all what I was expecting. It was, as I said, it was like kind of these like throwback hip graphic tees mixed with stuff you'd maybe more see at Lululemon or J. Crew, but it didn't resemble anything at all what I thought Abercrombie and Fitch was, which is, as you can see, why the business is doing so well recently.
Yeah. Yeah, they've added women's dresses, and those are selling very, very well. And men's suits, they never carried that before either. But a lot of that is because they were hearing from people like, we need clothes to wear either to work, because they are going back to the office now, or to things like weddings. And so they started that whole wedding shop business. It's like a shop within the shop of like, here's some outfits you can wear if you're going to like a multi-day destination wedding in like Cabo or something. And people have been loving it and buying up all those products. So yeah, they're an interesting business right here. I'm always a little leery on the trendy apparel, but the trends can last for years, as we've seen with like Lululemon, for instance.
Yeah, or even Abercrombie and Fitch back in the day. I mean,
back in the day, yeah.
It could last for a decade. Who knows?
Yeah,
so
yeah.
Right now, it's seeming like they have the formula right at the moment.
Yeah. So we'll see. I'll be tracking that one, but it's still got the number one rank. So, those estimates are still trending higher
heading into earnings. So it's impressive stuff.
Okay. I didn't have as easy as one as Abercrombie and Fitch, but I would have chose that one if you did not. So I had to go with a little more obscure names. And one I had never heard of. So I'm going to lead off with that one. And I too am going to share my screen, and it's POWL Industries. And that one is, I had to like go to the website, look around, go, what do they do? One of those, because you couldn't tell from the name. The ticker is POWL, and I just brought it up on Zacks.com. Obviously, it's the Zacks number one rank, but this is one that actually has the real good style scores. I feel it has a B for value, the B for growth, and then an A for momentum. And then that's when you're getting the A VGM scores. So I had to look it up, as I mentioned, and they say the leading supplier of custom engineered solutions for the management, control, and distribution of electrical energy. And you're like, what? Like, what does that mean? So they make custom engineered equipment that distributes, controls, and monitors the flow of electrical energy, mostly for the oil and gas industries and petrochemicals, including like pipelines, refineries. This is big business. They're in Houston because that's where you should be if you're in this type of business and these are your customers, but they're killing it. They're crushing it. And I looked at the last earnings report. I think for them it was fiscal third quarter, actually. And revenue up 50%. When are you seeing that these days? That was not an aberration either. It wasn't like a one-time quarter. And they said it was driven by strength across nearly all of the market sectors that they serve. They also did have a notable petrochemical order in the quarter. So they talked about that, but they see strong growth in the oil and gas sector, which I've been saying for a while is in a bull market again. So not surprising, this type of company that's making these products that go to this industry is also seeing real good things going on. So what do we have on value side? It's still really cheap, trading at 12 times. Price to sales 1.9. That's still pretty cheap there as well. And a PEG of 0.9 because we are going to have that growth component as well. I mean, projected EPS growth of 191%. That's pretty crazy. And all of these are pretty crazy. I was kind of curious about momentum. I didn't really look at it beforehand because the oil stocks have really come down over the last couple of weeks here in the summer of 2024. And so anything kind of associated with the oil industry has also been getting hit. But you can see 12 weeks, it is down a bit there, but not totally as terrible and not quite as bad as what we have been seeing in some of their customers here. But that's where I feel like a stock like this is a real bargain because of what it's doing, the strength it's seeing in its business. And, everything is looking real good. It's kind of a hidden stock that nobody really talks about because I didn't know about it. And I'm big in the oil industry. I did want to take a look at the price and consensus chart because this is one of my favorites. And it should, for the best of the best, be looking pretty good. You can see we have the 2025 in there because this is lightly covered. We don't have a lot of analysts on this one. So not a lot of data, but the stock, as you can see in 2024, has taken off as their business has taken off. And that's to be expected if you're growing your revenue at 50%. They also had a lot of cash on hand. So it's a stock I wasn't too concerned because their free cash flow is actually good. I wanted to go back just to the detailed estimates real quick, just to see, it's a smaller cap company. We only have one estimate on it. And I'm assuming because we didn't have a lot of other data for the prior years on that price consensus chart, that they only probably just started covering this company and we got the data in Zacks.com. But you can see for this fiscal year from $9 just 7 days ago, we had the earnings report come in and now the analyst is looking for $12 a share here in 2024. So that's POWL Industries, an interesting little play on the energy, but it's not an actual energy stock. Okay, then I took a look at EMCOR Group. This one is a little bit better known, but I never really dug deep into it either. But you shouldn't be surprised that some of the stocks that show up on this list are going to be in like the kind of hot infrastructure area, and that's EMCOR. You can see the style scores here, C for value. So it is a little bit pricier than what we were just looking at with POWL. A for the growth side, B for momentum. That's how you get the A VGM score. And let's just look a little deeper at the value side, because I know I did when I first dove into this, because I was like, dang, they're killing it. And are they cheap enough for me? Because I am the value stock strategist, but they got a PE of 18.9. That's not terrible. It's in line with their industry. It's cheaper than the S&P 500 would be right now, but it's not quite as cheap to make like a higher score on the value. Price to sales is very attractive here, though, at 1.1. So we almost have a value on that aspect. I'm not sure why the PEG is NA here, but they're growing the earnings very nicely. So looking at that aspect, we have projected earnings growth of 34%. That's what we like to see. And a lot of these other numbers looking pretty good too. Return on equity at 32%. I'm liking that. And projected sales growth down here of 15%. That's also nice. So when I looked into EMCOR, I had to go to their website too. They are a leader in mechanical and electrical construction, industrial and energy infrastructure, and building services. So as soon as I saw that infrastructure, I said, that's why they made this list. They did just report second quarter results. Quarterly revenues were at a record, up 20% to $3.7 billion. They had record quarterly earnings, up 78%. And they raised guidance, as you might assume, because things are going so well. They said pipeline continues to be robust and that their remaining performance obligations, like the backlog, is near record levels still, and that they saw record revenues in a couple of their segments, even though all of them were doing well, but electrical construction and mechanical construction at record revenues. So I'm liking what I see with EMCOR. I really love the infrastructure side of things. We're just seeing it so much with the data center build out, with the EV build out, both in EV cars and the batteries. We're seeing a return to manufacturing a bit in the United States. So a lot of these companies having to build out their manufacturing facilities. And then we have the huge infrastructure plan going forward with broadband, alternative energy, with Ben knows all about, highways, airports, all of that stuff, bridges being built, and these guys in building services also making changes along all of these lines as well. And a lot of things, on their end being built and that they're involved with. But let's take a look at the price of consensus. This is a bigger cap stock. So we have a little bit more data, and you can see 2024, 2025 soaring and up and to the right. That's what we want to see. That's why they made this screen. The shares are off their all-time highs here. Could this be a buying opportunity soon if we see a little bit more weakness? Perhaps. EMCOR Group, ticker EME. They also pay a dividend, just yielding 0.3%. You're not really buying it for that, though. And then my third stock is on the healthcare side. So there were several healthcare type stocks that made the screen. I chose Universal Health Services, ticker UHS. And not quite A's across the board, but close. We have A for value, A for growth, B for momentum. That's how we get the AVG score of A, the VGM. And let's take a look real quick at the deeper side of the style scores. Value, this is a value stock as well with a PE of 14, price to sales of 0.9. Price to book is low, 2.1, PEG ratio of 0.7. This might even make the screen of classic value stocks, just looking at these. So not surprising it's got that A for the style score. This is all cheap according to its industry. It's pretty cheap. And according to the S&P 500, for sure, it's cheap. On the growth side, projected earnings growth this year of 42%. That's really high. And one of those reasons is they did raise revenue and earnings in their last earnings report. Revenue was actually up 10.1% to $3.9 billion. And they also raised their buyback again. They had a pretty big buyback, but they had spent most of it. So they added another $1 billion on there. So they have a $1.228 billion buyback going on at the moment. So it'll take a little while for them to buy all those shares up there. But what does Universal Health Services do? One of the nation's largest and most respected providers of hospitals and healthcare services. They run 27 inpatient acute care hospitals, 332 inpatient behavioral health facilities, and 48 outpatient facilities and ambulatory care access points. Again, I'm really liking everything I'm seeing, as I should. These are the best of the best stocks, as Ben and I have both been showing you. That's why we're doing this podcast. We're over the doom and gloom of, things are bad. The economy's doing this, that. Here's the price of consensus. It's looking very good, up and to the right for several years. We even have the 2026 here being raised on this chart, and the shares up at new 5-year highs, finally busting out of the trading range here in 2024, but still cheap, as I mentioned. So this is some interesting charts, Ben. And what do you make out of the three that I chose? Do you know anything about any of these?
So the first two I have like a broader portfolio of stocks to keep an eye on for alternative energy innovators. A few of those have come across my radar. anything broadly with, as you alluded to, like big infrastructure spending, quote, energy transition is going to be, I think, just be exposed to that for the next 10 years plus. I mean, this is these big mega trends that, if anything, related to where the money's flowing, that is where these companies are going to be able to thrive for not the next year, but literally the next decade plus. Of we're going to undergo, if everyone is correct, a massive transition that we haven't seen in, honestly, generations. So anything in that broader infrastructure and energy transition world that's related to electrification or anything like that, or like grid hardening and expanding infrastructure, is going to be a huge play. So yeah, those first two stocks were certainly names I've come across, but none I've actually added yet. So maybe now that we see these recent earnings results, I'll have to get into them.
Yeah, me too. I'm like taking some notes here for the value investor portfolio. I'm not going to lie on all of these, really, because they do have the good style scores for the most part for value as well. And it is rare to find the value with the growth and the beat and the raises and, the craziness of, we still see strong demand for the rest of this year, when we're hearing all this doom and gloom about recessions and all this other stuff going on. It just goes to show you not every part of the economy has slowed down here in 2024. And there are these parts that are still seeing, strong business right now.
Yeah. I mean, there's just a lot of factors that are going to contribute to those areas doing really well for a long time. And as you said, anyone can say, it's doom and gloom in the economy. But if you're looking at the actual company and they're saying, hey, our business is doing really well, go to those companies then, especially at a time like this when everyone's like, oh no, the economy is tanking. It's like, well, they're telling you their business is booming. So
yeah. It was very uplifting to read some of these earnings reports. And these are just 5 out of the 19. So it's an interesting time, but you might as well deploy the Zacks rank, which, should get you rising earnings estimates if you're looking at those number ones, and use the style scores to try to find, if you're into the growth, use it for the growth component. If you're into value, use it for that, or all three with, those two with the momentum with the VGM overall score will also get you some really good quality names. And that's kind of key right now. So that's what we aim to bring you here at Zacks. That's what sets us apart from everyone else, is that we have the rank and the style scores and nobody else does. So I like to use them. I like to dig deep and find these kind of secret or unknown stocks like POWL Industries. Never heard of it, but it's on my radar now. And, keep all of these on your short list, because you should be listening in on these conference calls, doing your own due diligence on them, doing your research. But always these screens are a good way to really reduce the number of stocks down to those with the best fundamentals right now, basically.
Yeah, 1,000%. Yeah, I think this was great. I think especially at a time like this, I think finding the stocks that have the earnings revisions going up is showing that their business is doing well, and adding that VGM side of it is really a great screen to look at the moment.
Yeah. So these 5 best of the best, I'm going to recap the tickers now in case you missed them. We had H&R Block. Its ticker H as in Harry, R as in Robert, B as in boy. We had Abercrombie and Fitch, the apparel retailer, A as in Andrew, N as in Nancy, F as in Frank. We had POWL Industries, the one that's making the engineered custom equipment for the oil and petrochemical industry, P as in Paul, O, W as in Wayne, L as in Larry, POWL. Then we had MCOR on the infrastructure side, E as in Edward, M as in Mary, E as in Edward. And then we wrapped it up with healthcare with hospitals, Universal Health Services, U as in Uncle, H as in Harry, S as in Sam, UHS. And as always, we aim to bring you as many stocks as you can every week. We're also going to talk about the economy coming up. I'm going to have Dr. Blank on to give us his insights into the whole recession argument. Are we in one already? I already know what his answer is going to be on that, but you're going to want to tune in to find out. It's time to have him on again. So do not miss a single episode. Get us as you are on Zacks.com's YouTube page. Just go to Zacks.com/YouTube. Get us on Apple. We're on Spotify, Amazon Music, as I mentioned earlier. But get us somewhere, and I'll see you again next week with some more stocks.